as we go along. So I'd like to start by introducing David Holmes, who is our presenter. David is a chartered professional accountant, a chartered business valuator, and is certified in financial forensics with over 20 years of valuation, finance, and accounting experience working with organizations that have ranged from large publicly listed companies to smaller owner-managed entities. David is the past academic advisor to the Canadian Institute of Chartered Business Valuators and York University, where he was responsible for overseeing the CICBV, which is the Canadian Institute of Chartered Business Valuators program of studies. David's a partner at Rumley Holmes LLP, a professional services firm with over 20 professionals, where he advises business owners on valuations, the purchase and sale of businesses, and tax minimization strategies. So without further ado, I'm going to turn this over to David, and he will start his presentation. Thank you.
Okay, thank you very much for having me, and thank you for the very kind introduction. And thank you all for joining us today. So today's presentation, as we sort of mentioned, is going to be on how to value a business, how to properly value it, and hopefully some other useful tidbits for you as we go through. So this is my first time doing a Zoom presentation, so just bear with me if I run into any sort of issues along the way here, technologically. And yeah, we'll get started. So, okay. So yes, I won't go through in any more introduction, but that's at the end of the day, I'm a partner with Rumley Holmes. Most of my practice, I would say about 80% of it is business valuation centric, maybe 80 to 90% centric. So I do those business valuations for a number of reasons. They can vary from buying and selling a business, shareholder disputes, matrimonial issues, and any number of things. Like a lot of times you might have a business that has 3 partners and one partner wants to retire, so then the other partners need to determine what value to place on the business without actually exposing the business to the market. So that's kind of the world I play in. And we can see the before and after picture of COVID. Before COVID, I had hair. I no longer do. So just to go over some of the things we're going to go over is just sort of the concepts of fair market value versus price, the business valuation process, the different valuation approaches and methodologies, how to prepare your business for sale, how to maximize value, selling a business during COVID, because I feel that's going to be pretty pertinent to possibly a lot of the people here, and just tax minimization strategies, and then some common issues when buying and selling a business. So the first thing is the concept. When I'm asked to value a business, I generally am going by the definition of fair market value. And the definition of fair market value is the highest price. It sort of has 6 components, which you can see in the diagram. And that is the highest price obtainable in an open and unrestricted market between informed and prudent parties under no compulsion to act, acting at arm's length, and expressed in terms of cash. And I'll sort of just go quickly over these to sort of give you a little overview of what each of those components means. So the first one being the highest price obtainable, pretty self-explanatory. It is, when you're trying to determine the fair market value, you are just trying to seek the highest price that's reasonably obtainable in the market. That becomes more of an issue on the notional side, say when I'm doing a valuation for something that's contested, where one party might want a lower or higher value. You kind of have to remind people that we are trying to just obtain the highest price. The other parts, like open and unrestricted market, being that there's nothing impeding a sale of a business. Informed and prudent parties means that both parties have an equal amount of information and all necessary information to make a informed decision. that the parties are under no compulsion to act, being that they, one party, there are many times when an individual may be compelled to sell a business because he's under financial, health, or other constraints. So sometimes that individual may sell the business for less than fair market value. Acting at arm's length, part of transactions between related parties, like a number of the, a good chunk of the work that I do is for valuing businesses as they get passed down from one generation to the next. And it isn't always that, say, parents, when they're looking to pass the business to the next generation, are looking to maximize their value. So they may agree to a price that is not equal to fair market value. And then expressed in terms of cash. So this is another big thing. I often get times where clients or individuals will approach me and they will say, I have this business to sell. I know that, Susan down the road sold her business for $10 million and I want $10 million too. The thing is, you have to sort of parse through some of that, because that may not be in terms of cash, being that someone can sell their business and only get a small portion up front, and the rest of the purchase price is contingent on future events or payments over time. And so you have to put that in terms of what is the value today. Okay, so that's fair market value. And then you have fair market value and price. So if we think of this like a stock market, in the stock market, stocks trade based on their price, being that a given stock will sell for $50 on a day. That is the price of that stock. And it won't always equal its fair market value. That is what, mutual fund investment managers are trying to do. They are trying to find securities that trade below, whose price is below their fair market value. And so there's a number of reasons that price and fair market value aren't always equal. Those generally are items such as related party transactions, just in the case where I mentioned parents passing a company down to the next generation. The price they agree on won't necessarily equal fair market value. There could be differing negotiating abilities between the parties. Compulsion to act. As I said, if someone is under financial, health, family, emotional distress, they may make a decision to sell a business not equal to its fair market value because they need to get out. Likewise, people may pay a price for a business that greatly exceeds the fair market value because of emotional and other considerations. There could be uninformed sellers and purchasers, being that at times people will agree to a price for a business that isn't equal to the fair market value because they don't know any better. And then as well, price not stated in terms of cash, which we talked about. And the other thing is synergies. So at times, an individual or a company may pay more for a business than it otherwise is worth due to synergies they may realize. This is more common in, say, two like businesses and one business buying another. And they know that when they combine those businesses, they are going to enjoy certain synergies or cost savings. So in that instance, say you have a business that's making $100 a year, and if another company can buy it, but then trim expenses and overheads such as accounting and sales and management and that sort of stuff, they may buy a business that is earning for itself $100, but they can enjoy $120 of earnings and therefore will pay a value in excess of fair market value. As far as the business valuation process goes, I don't know if people are seeing that, I'm just moving that around. There's a number of, this sort of process goes from information gathering, discussing that information with management, we perform some research and analysis, and then we issue conclusions of value. Okay. So this is where I would say this is probably one of the more important slides, and I believe, as was mentioned, after the presentation, I'll make this presentation available to all, but this is, at the end of the day, sometimes evaluators and professionals, can overcomplicate situations and things that they do. when it comes to valuing a business, if we really just bring it back to its bare bones and that sort of thing, the value of a business is dependent on three primary things. It is what is the business earning, or what is the cash flow that it's generating. So in that respect, I'll kind of use cash flow earnings as is synonymous about the same thing. What is the appropriate multiple to apply? And then what sort of balance sheet adjustments are necessary. And it's also key, because I'll sort of be going through the various methodologies of valuing a business, that they all are meant to, at the end of the day, they are all trying to arrive at what the present value of the future risk-adjusted cash flows of that business are. So no matter what methodology you take, it's you know, there's some methodologies such as the discounted cash flow methodology that is a very literal translation of that. You are calculating the present value of the future cash flows. Other methodologies such as like a price to revenue, price, you know, enterprise value to EBITDA, various other sort of metrics that we'll go through, they're still just trying to arrive at the same thing. What is the present value of the future cash flows? The other thing I'll just point out just early on in this presentation, as far as valuing your business and when you're thinking of selling or buying and that sort of thing, the best time to think about selling your business, and I put here as early as possible, but when you start your business is when you should start thinking about selling your business. Because that's ultimately, that's the way you want to build your business and run your business ideally, is build it to sell it, because that event will happen at some point. And it takes a number, it could definitely take a number of years to properly prepare a business to sell. So, and if you're running your business that way from the beginning, then it makes it all that much easier. So now, as far as the valuation approaches go, when you sort of are first looking at a business, and I guess the other thing to mention is that at the end of the day, not all businesses have value, being that some businesses are just wound up and you know, the assets are sold and the liabilities are realized, and it's not really a situation where you are selling the business for a multiple of earnings. So, and I'll sort of get into why that is later, but not all businesses transact on, say, a multiple of earnings. But the first question we ask when we look at a business is the business a viable entity? If the answer is yes, then we use what is called a going concern approach. And that can be an income-based, market-based, or asset-based approach. And then if the answer is no, then it's a liquidation approach. I'm not going to spend any time on the liquidation approach, because it's really, that just means a business is in danger of insolvency or is not able to operate. Therefore, it's just going through a liquidation process. But again, all these things are measuring the present value of future cash flows. So even when you're doing an asset-based liquidation approach, you are just measuring the present value of the future cash flows. You're still looking at that business, what it owns, what amount of money you would obtain for those assets, and what they are worth today. Because even in a liquidation, it takes time to go through. So then I'll sort of go through the various approaches and methodologies. So this is all under the, well, there's going concern approaches. There's the income, asset, and market. And then you can see under these, there's various income methodologies, such as the discounted cash flow, or capitalization of cash flow, or capitalization of earnings. Under the asset approach, there's liquidation and adjusted net asset. And then the market approach, which market and income are very similar. The market approach just sort of means that you're using multiples based on publicly available information, such as publicly traded stocks and or transactions. And that sort of thing. There are sort of databases out there for private transactions as well, so you can get some information there to sort of see what the going market rate is. So the most common approach is the income approach. And I would even say in my practice, 80% or so of the valuations I do are a capitalized earnings or cash flow approach. And so those approaches are most pertinent when the business is mature, consistent cash flows. You can reasonably estimate what the next year is going to be like based on the last 3 or 5 years. And it's used for a business where forecasts are not available or reliable. And so a key reason why 80% or so of the valuations that I do use this methodology are that for businesses that have sales of anywhere from $100,000 to $5 or even $10 million and more, they do not have a accurate and reliable estimate or forecasting procedure. That's more common once you get to companies that have $100 million in sales and are public companies. They have a whole accounting department. They're constantly projecting their cash flows out 3 to 5 years. So then you have some sort of metric in which to sort of base that discounted cash flow on. But in the sort of small to mid-market, most of the businesses are valued using a capitalized earnings or cash flow. Okay. So, and then discounted cash flow, appropriate when the business is experiencing fluctuating cash flows, it's a startup business, or it has a finite life. An example of that would be like a quarry where, you know, there's a certain amount of rock they can extract, and at the end of that, then the asset's done. So, and again, sort of to go back to what I was saying at the beginning, you know, the primary drivers of value are what are the earnings, what is the multiple, and then some balance sheet adjustments. The first thing that you need to the sort of first step is determining what the normalized earnings are. And so what you're trying to do there is take the reported earnings and then state them to what earnings or cash flow is going to accrue to an anticipated purchaser of the business. And in the small to sort of mid-size market, the most common adjustments that need to be made to reported financial statements are, you know, you have to adjust any owner manager remuneration to a market level. So in a given business, you could have the owner of the business who may pay himself $1 a year for various tax or other reasons. Or you may have a business owner that's being paid $2 million a year for, again, various tax and other reasons. And you need to state that onto what is the value that is being delivered. What would you have to pay to replace that owner manager in the business? The next most common adjustment is any non-arm's length transactions. One of the most common thing is rent paid to a related party. So if you have a business that owns the real estate from which it operates, then you need to restate that rent or include rent based on what an arm's length purchaser would pay. And that goes even, a lot of times in a given business, if they have real estate, it's more common that it'll be owned by a company, a separate company. And so then you are normalizing those rent payments that are going over. If you have a situation where the business owns the real estate from which it operates, you still have to make this adjustment because the real estate and the business are separate and distinct assets with their own risk profile. Being that if you say own the business you're operating from, the theoretical multiple that's being applied to the real estate is generally much greater than what you're applying to the business, because the real estate is a hard asset, it has a variety of uses and that sort of thing. So it's just important that we value those two, the operating business and the real estate separately, and that we need to sort of put what an arm's length purchaser will pay. Because even in a lot of situations, if the company owns the real estate it operates from, or whether it's within the company or without, when they sell the business, they will often only sell the business, they will keep the real estate, and then they're going to enter into a market rate of lease. Other adjustments are significant one-time items. So that is, there can be times where either both on the revenue and the expense side, that there could be, you know, items that are not expected to reoccur. Because when we're normalizing the earnings and cash flow, we're trying to determine what is going to accrue to that purchaser. And say in the past year, there was a one-time contract that caused revenue and profit to spike, then you need to normalize for that. Similarly, if the business incurred a large expense to, say, put in a whole new IT system or bought a bunch of computers, their expenses may be overstated in that 1 year, so those need to be normalized. The other common adjustment is for discretionary amounts. So I'm sure no one watching this presentation is in this boat, but there are times where business owners may deduct things that are not necessarily for business purposes. So if that were to happen, you need to adjust for those amounts. So common things are, like your vehicle usage. Often there may be 2 vehicles in the business when only 1 is needed. And there can, just a variety of personal expenses. So by discretionary, I also mean personal amounts. It's basically those expenses that aren't required for the business to operate normally. Okay, so then once we have determined what the economic earnings of the business are, the next thing is determining what the appropriate multiple is. Okay, so from the easiest standpoint, you sort of think about, you have a company that makes $1,000 a year, and you apply some sort of multiple to that to arrive at what the business value is. So in the case of using a 5 times multiple, the way we determine that multiple is actually the inverse of the multiple. So it's what's called a capitalization rate. And so if you're using a 5 times multiple, that is equal to a capitalization rate of 1 divided by 5 to get to 20%. And I'll sort of go through how you arrive at that sort of multiple or percentage. But, the most fundamental way of thinking about it is that, once we've determined what those earnings or cash flow of the business are, then we need to adjust those for the future risk of them reoccurring. Because that's ultimately what the capitalization or the multiple is trying to do. It is trying to, basically risk adjust those. If those future earnings and cash flow have a low probability of reoccurrence, then they will attract a low multiple, which is also a high capitalization rate. If those earnings have a high probability of reoccurring, then you'll get a high multiple, low cap rate. Okay, and the general way that we determine what the multiple or capitalization rate for a given business should be is that we are comparing the subject business to the rates of return offered on other investments. Okay, and so this is sort of best explained by the CAPM or capital asset pricing model. So, and what it is a buildup of risk. Okay, so you start with, we have our subject business, and we compare that to what a potential investor could achieve in the market. So the first thing they would say, what is the least risky investment? And that's what we term the risk-free rate. And that is generally considered to be long-term government bonds, as the risk of default of governments, notwithstanding our current financial situation, is generally low. So for instance, at the moment, like a long-term government bond, I think in Canada is say about 1.5%. So that's sort of your starting point. I could earn 1.5% on a bond, and I'm comparing it to the subject business. So the subject business is riskier than that. Then you say, what is the equity risk premium? And what the equity risk premium is what is the risk associated with, say, the S&P 500, just a large basket of large publicly traded stocks. Because again, that's the potential investor in your business's choice. Do I buy your business or do I buy these other things? Then you look at an industry risk premium, being that, say, the S&P 500 made of 500 stocks of various industries. So then say we were looking at a manufacturer of car parts. So you then dig down into that, and there's statistics that show that an auto parts manufacturer will have a X% risk premium, say like 1 to 2% above the S&P 500. You then note that your choice of buying, say, Magna, a large publicly traded auto parts manufacturer, versus a single company is much different. So you apply a size premium. That's to reflect the fact that a small company has a number of risks and does not have the economies of scale of these large publicly traded companies. So you apply a risk premium. And then we get to company-specific risk, and that's where we look at the individual company, how it operates, and attribute a risk ratio to that. And that's how we sort of come up with our overall risk rating, and then that translates again into the multiple. Yeah, so another sort of income methodology that's common amongst smaller business is something called the seller's discretionary earnings approach. So the difference between what I sort of was outlining there are capitalized earnings or capitalized cash flow or multiple of EBITDA, is applicable to, it can be applicable to all businesses. As the businesses get smaller in size, then that always doesn't equal, because what I was saying about replacing the owner manager, some businesses need to be owner manager run at the end of the day. Anybody buying it is going to be running it. So then you can use this seller's discretionary earnings approach, which is basically where an individual, for lack of a better way of describing it, is looking to buy a job. They know they're going to go in there, they're going to operate the business and that sort of thing. And so you look at seller's discretionary earnings, which is just like the earnings of the company. The only difference is you add back the owner wage, because it's just ultimate cash flow to the owner. The big difference between the two approaches is just that the multiple that you would apply to the seller's discretionary earnings is a lot, I shouldn't say a lot, it is lower than what would be applied to earnings. And the reason for that is just that in a cash flow, like a standard cash flow or earnings multiple, you have a number of buyers. You could be a financial buyer who's going to buy the business, hire someone to run it, and they therefore will accept a lower rate of return. If you actually have to operate it and are fundamental to that business, then generally, all else being equal, you will request a higher rate of return. The market-based approaches, sort of guideline public company and precedent transactions. This is just where you're, in that scenario, you could be, say, a mid-sized auto parts manufacturer, and you look to the public company to see what similar companies are trading for, and you can apply various adjustments to that multiple to arrive at what the multiple should be for your business. The other one is precedent transactions. So you will look at, again, there's both publicly traded precedent transactions and there's private ones. This is no different than, say, in the case of selling a home, where when you are trying to price your home for market, you look to what the other houses in the neighborhood sell for. And you say, 2 doors down sold for $500,000, but it had a pool and hardwood floors, whereas my house doesn't. You compare it to the one, 4 houses down that had a nice yard, but it was in a bit of disrepair, and the other one that needed a new roof. So you're essentially trying to assemble that data from other similar companies and make adjustments then to arrive at the value of your company. And this is a tough one. Like with this small to mid-sized business, like comparing them to public companies can be quite challenging, because generally a smaller business has a narrower stream of revenue and narrower service offering, whereas public companies tend to have much greater. Public companies also tend to have a lot of more customers. Customer diversification lowers risk, whereas private companies don't. But when it comes to precedent transactions, there are databases where we can look to see, basically where business brokers across North America report into a couple databases to then try and give people help in pricing businesses. And I have access to a few of those databases. And my finding is that tends to be, it's hit or miss on any given business, because there are some businesses where you will look up that type of business and you will find quite a few precedent transactions that are reported into these databases. Other businesses, you will look them up and you will find nothing similar, or just not enough data for it to be meaningful. You might only find 3 transactions whose multiples are all over. So the typical sort of market valuation multiple or techniques, we'll say, are the enterprise value to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is meant to be a proxy for cash flow. The thing you'll notice is that it does not include depreciation and amortization, which is the cost of capital equipment. So the multiple has to reflect that it doesn't include that type of thing. In certain businesses, they aren't very capital intensive, so that methodology is very applicable. Other businesses that tend to be more capital intensive and therefore have larger depreciation and amortization charges, it's less applicable to. So price to revenue or enterprise value to revenue, this is where you're trying to just look at sales and apply a multiple. That is a very tricky and dangerous multiple to use, because you can have 2 businesses, both with $1 million of sales. One is making $500,000 a year and the other one is making $100,000 a year. Obviously, you would rather have the company that has $1 million of sales and $500,000 of earnings, and you're going to apply a different multiple to reflect that it is much more profitable than the other business. And so in the price to revenue or price to sales, some sort of sales metric, is really, it generally only applies to very few businesses, and it needs to be double checked through other methodologies. A common example, actually, oddly enough, is accounting firms. Accounting firms tend to sort of trade on some sort of multiple of revenue. The reason they do that, and the reason that any business trades on a multiple of revenue, is because the potential purchaser knows that they can grab those sales, and they know for every dollar of sales how much profit they're going to get. So in essence, it's kind of it's a quick way or cheat sheet way of getting to what the cash flow is. Applies to other business too, like insurance brokerages can often trade on that, and some sort of, as well as some investment management companies. Other multiples like price to earnings, you probably hear that in the market, you know, or if you listen to radio or financial news, that sort of thing. PE multiples stands for price to earnings. Price to book value is another one. That's common, actually. Banks trade on price to book value. And then there's industry specific multiples, such as enterprise value to AUM, that stands for assets under management. That's common with, say, mutual fund companies. And then enterprise value to number of unique users. That is actually very common in public companies for like Facebook and social networks. They basically found that that is the #1 indicator of value, or the most correlated indicator of value for social networking companies. And then this is just a quick example showing you how that sort of works. And again, it's all coming down to, you know, in this example, we just have a multiple of EBITDA. So you can see, you know, you've determined the maintainable EBITDA, you apply a multiple, and you get to the value of the business. And so again, that just goes back to those first principles. What are the earnings? What's the multiple? And then some balance sheet adjustments. So as far as what I mean by balance sheet adjustments is that you need to, when selling or buying a business, you have to define what you're buying or selling. Being that a business that's been in operation for, say, 20 years, and where the owner is, say, fairly frugal, that business, if it didn't discharge those earnings to the owner, will have accumulated those earnings over years. So it could be sitting on a whole bunch of cash. It could be sitting or it could have a large receivable balance, or it could be sitting on more inventory than it needs, that sort of thing. It's also common with private companies that they've made loans or advances to related companies. So all these things, that sort of noise on the balance sheet, needs to be adjusted for, normalized to what are normal operating conditions. And the most simple one is cash, right? At the end of the day, if you had a company that had $500,000 in cash and you were going to sell it, well, that cash is yours. You've made it. Yes, the business may need a certain level to sustain operation. But you're going to pull out whatever you can before you sell it to maximize your proceeds. And that's sort of where we go through a working capital analysis to determine what amount of working capital the business needs. And I guess, sorry to get to accounting for those that aren't. Working capital is the current assets minus current liability. So that is you take your cash, accounts receivable, inventory, and you deduct off your current liabilities, which are generally, the unpaid bills, some payroll, and other current liabilities that are due within a year. And so every business kind of has a current working capital balance. And it's just sort of determining what a given purchaser will need to operate that business as a going concern. It goes from, in smaller businesses, it's more common that we are selling them with basically zero working capital, i.e. the receivables equal the payables, or the cash plus receivables plus inventory equal the payables, something around a 1-to-1 ratio there. And at times like 1.25, that sort of thing, so you'll just have a bit of excess cushion there. And then you'll have other businesses, again, sort of like manufacturing tends to be very working capital intensive because they're, certain clients or certain industries, the customers like to extend terms. So they commonly aren't paid for 30, 60, 90 days. Therefore, the company has a certain level of working capital that's needed to maintain operations. And then as far as the asset-based approach, like I said, all businesses aren't saleable, or I should say that it's not worth selling them because they're just worth their asset value. And so under that approach, you're just really looking at what the assets are worth and what you're going to get on wind up and that sort of thing. We do look to now I should say that we will always look to the adjusted net asset value of the business, or adjusted book value of the business, because that does provide downside risk to a purchaser. Because one key sort of valuation principle is the greater the adjusted book value or adjusted net asset value or tangible net worth, the greater the value of the business. And that is because, if you have a business that is capital intensive, if you have expensive machinery and equipment that's required to keep the business going, then the value is going to be higher. And it presents downside risk to a potential purchaser because they know, okay, if the business doesn't work out and it doesn't succeed, I can at least sell these assets for a dollar amount. You compare that to a software company or a company that doesn't have a lot of capital assets. When you're buying a company like that, you are just buying essentially intangible items. And if the business doesn't work out, they're not likely worth much afterwards. And then there's a little cheat sheet there for reference, just sort of showing the different methodologies and when they're applicable. Okay, so the next thing we'll talk about is minimizing income taxes on the sale of a business. So the key dynamic to remember here is that purchasers prefer to purchase assets, sellers prefer to sell shares. And the reasons are inversely related. A purchaser wants to buy assets because they want reduced exposure to liability, and they want to realize a tax savings on a fair market value bump of assets. So, and then conversely, sellers prefer to sell shares because they can realize tax savings on the sale of shares, because if your company qualifies as a small business corporation, there's a one-time capital gains exemption available to every individual. So the seller, if they are able, wants to sell those shares to realize that tax-free gain, and they receive reduced exposure to liability. So you can see the purchaser wants to buy the assets because they have lower liability. The seller wants to sell the assets to reduce their liability. And likewise, the purchaser wants to buy assets because it's more tax advantageous, whereas the seller wants to sell shares because it's more tax advantageous to them. So this stuff all ends up, when it comes to a transaction, is just being a negotiation. Sometimes there'll be, there's various risk reward dynamics to these aspects. For instance, if you had, say, like a company that's involved in environmental cleanup, they are a risky business from a potential lawsuit standpoint. So very few times will you actually have the share of the business sold in that case, because the shares retain too much liability. And maybe to back up a second. So when you have a company operating as a corporation, that company, when it is sold to a potential purchaser or to a purchaser, retains all liability for past actions, as well as income tax and other things. So that's where, when shares are sold, there has to be a significant amount of due diligence done by the purchaser to ensure that they're not buying a whole bunch of unknown liabilities. And so, and that's sort of the case, like certain businesses can't be done as share sales because they just naturally have too much liability that they could be exposed to. And even if you have, like, it's also common, you'll sign an indemnity agreement that basically says you will protect the purchaser against all past liabilities, but that only goes so far, because at the end of the day, if there is a lawsuit, they sue the company, and it's the company's obligation to defend that lawsuit. They can then go back to the seller and say, you owe me money or whatever because you did this, and I'm now going to have to pay money. But it goes to possession is 9/10 the law. At the end of the day, when you buy the shares of the company, you own those shares, you retain that liability, you have to defend those lawsuits or speak to those, and then you have to go back and obtain relief from the purchaser, right? So there's, at the end of the day, purchasers don't want to buy those shares unless they're fairly confident there's not going to be any significant issues such as that. Yeah, and then tax savings, when you do buy the assets, you generally get what's called the fair market value bump. So if you had a business that had been operating for 30 years, a lot of their assets may have been written off for tax purposes, but if you buy those assets, you then have the ability to bump the value of those assets up, and then you get to claim capital cost allowance, which is a reduction of your taxable income. So when you buy the assets, essentially you get to puff up those values and deduct those for tax purposes, which gives you tax savings in the future. And I feel like it just comes down to a negotiation, because certain of these things will be more valuable to one party than the other. Like, I had a transaction in the spring, and we wanted to sell the shares, they wanted to buy the assets, and then you get into, you end up quantifying the difference between each party's benefit and hopefully arriving at a midpoint to come to a reasonable conclusion. So then, as I was mentioning, the one item that is most of them, or as a business owner's goal, is to one day realize tax-free money. Everybody loves tax-free money. It's the best type of money there is. So that is where the capital gains exemption, there's a one-time capital gains exemption that's available to each individual, which shelters $866,912 from income tax. That amount changes every year. It gets indexed to inflation. It started out at 500,000. The government bumped it up years ago to 750, then to 800, and then now it's indexed to inflation. So it changes all the time. And this is sort of like, to the point of, you want to start planning for the sale of your business the moment you start it, and years in advance, is you want to do a number of things to ensure that, if possible, you can use this capital gains exemption. And that often, and sometimes that can take a period of 2 years or more to be able to achieve that. And as well, there can be opportunities in certain instances where someone can multiply their capital gains exemption by doing a freeze and, putting shares to a family trust, and then the trust can then use its beneficiaries exemption. So there are cases where people get to multiply that exemption. And again, that's just something why you start thinking about it early on, and that's something to talk to your accountants and accounting firm about if you see something coming down the pipe in the future years. And if you're going to have a value, of course, like some businesses aren't worth over $866,000, so it may not be an issue. But if you do have a business that might be worth a few $1,000,000, then you want to do what you can to maximize the tax-free money. Just quickly, as far as to be considered a qualified small business corporation, it has to be Canadian controlled. Substantially all of the fair market value must be used in the active business. There is no strict definition, but it is generally known to be 90%. And this is where I've sort of said, if you owned a business for 20 years and you have accumulated a bunch of excess cash, or if you have accumulated money that maybe you loaned to a related company to then buy a piece of real estate or do something like that, those assets are not considered active business assets. So in preparation for a sale, it's common that we have to purge a business's redundant assets out of the business in order for it to meet the QSBC definition. And then it must be held 24 months. So you can't just have have owned a business for 4 months and then realize this exemption. It generally needs to be a 24-month holding period prior. There are certain exceptions. So if you do have a sole proprietorship, this exemption can be available to you if you have not incorporated, because there is an exemption whereby in certain instances, you can take a proprietorship business, you can transfer it on a tax-free rollover to a corporation and then sell those corporation shares. And because you operated the business for X number of years before, then you can actually use that capital gains exemption without having actually owned those shares for 2 years. But again, best thing to do is prepare in advance and be thinking about this more than 2 years in advance. And that's just sort of pointing out, big thing there, that tax savings is worth over $230,000 per shareholder. I think my calculation is probably a year or two older. Our tax rates seem to be going up and may continue to do so. And then there are sort of, like I said, those businesses where you can't sell shares, you can't get the purchaser to buy the shares. There are tax minimization strategies to take advantage of that. You do get access to certain things like a capital dividend account. You can use your corporation as you're basically like an RSP, have that corporation with cash, invest that cash in investments like you would an RSP, and then you draw down the proceeds over the term of your retirement. So, it's not some people get really focused on just the share sale when it may not be practical or doable, and there are ways to minimize taxes even in asset sale. Then just a quick, like large transactions need, have greater complexity, and so that's more applicable to sales that are, say, $5 million and above. They'll get into some, and I shouldn't say that, like, even some of these things, prepping a business for sale, it's going to be like, say, if I'm helping someone, I'm putting them in touch with our tax and estate planner who does this sort of tax work to make sure that everything is optimized for sale. So. Okay, then some tips for preparing your business for sale. Again, think early. It's too often that I get approached by people who don't truly think about selling a business until they're tired of running their business. And it's just an opportunity missed, because when a business owner has checked out or is getting tired and their sales are going down and they haven't been spending money marketing or trying to attract new clients, it impacts the business's value. You know, the simple and close to the sort of home example is like an accounting firm. At times, we've looked at other accounting firms or accounting practices, and the practitioners get tired. They aren't doing any marketing. Their client base is eroding, and their client base is getting older. So all those things factor into the value that they might realize on their business. If they had maybe thought about selling earlier and continued to build their business and market and try and, you know, reinvigorate their client base and that stuff, they'd realize more money at the end of the day. So start early, and especially before you've sort of mentally checked out. And I find the other thing is, like, sometimes it hits people like a wall, in that I've helped business owners where, say, they were 60 years old and it was great. They were having a good time, still enjoying it, all that sort of thing. And they thought they were going to do that for another 5 or 10 years. And then potentially a health problem pops up, or you sort of get this, they hit the wall where it's just, they start coming, you know, it just happens either all at once or over a period of a few weeks, where they start going to the office and they get tired of hearing from their clients and their customers. And it just hits them like a wall, and they just go like, I don't need this anymore and I want out. That's where planning in advance, planning ahead is the most important thing, because then planning doesn't doesn't require you to sell. So it's better that you're thinking about it, preparing your business for sale well in advance, just in case some event occurs where you do want to sell. Well, now you've already sort of done that initial work and consideration to make it as saleable as possible. The other thing is, like, make sure you evaluate your options. Like, as you're planning for a sale, you got to think, who would want to buy this business? Sometimes it's family members. Again, plan early, because there's a lot of tax minimization strategies in doing so. Management and employees. Also, another good exit strategy for a lot of business owners is they might have a younger manager employee who's looking to come on, who's put in some time, shown competence, and when that business is up and running well, they can pass it on to those managers, that manager, or the employees. Or sometimes it's always just a third party or competitors. Like, so if you think it could be sold to competitors, you got to think about who those are, what would they want to see in a business, that sort of thing, right? Other key planning steps, you know, it's important to understand the range of your business's worth. And this is where sort of consulting with your accountant and especially your financial planner to make sure that, you know, if the sale of your business is going to impact when and how you retire, you need to understand what it's worth, so that you can then know if that is going to meet your future retirement needs. Because you don't want to get to 65 and get a surprise that your business isn't worth what you thought, or may take 2 or 3 years to sell, and then you know there's various things. So again, planning. Another big thing is, as much as possible, you want to make yourself redundant. You want to document processes and procedures. The easier a business is to come in and run, and the less it needs you, the more it'll be worth. So this is not, you know, if you have someone running the business, it becomes a very attractive business to other people that may not want to do that as a full-time job. So if you have someone running it and you are not necessary to the daily operations, it just makes the value worth more. And the thing I hear too often is, well, all the customers know me, need me, I'm so important, blah, blah, blah. At the end of the day, no one is irreplaceable. You know, there are certain businesses where you just can't get around it. I understand that piece, but in a lot of businesses, you can make yourself redundant. You can get rid of yourself. You just need the proper management techniques and framework to get yourself out of there. because that's the ideal situation in a way, where you start winding your life down, start working less while the business is still operating optimally. So you're not checking out, because if you're winding down and the sales are following, that's bad. If you're able to wind down and the sales are maintaining and keeping on expanding, then that's ideal. And then you can, when you go to sell, it's worth all that much more. The other thing, keeping detailed and clean financial records. When I said about, the earnings and multiple, and people are trying to risk adjust the future cash flows of a business, the cleaner the financial records, the less risky it is. As in, if you do run a lot of personal or discretionary amounts for the business, then when you go to sell it, you have to show the potential purchaser, yeah, okay, the company only shows it makes $10,000, but here's what you don't see. It's, I deduct 3 cars, a snowmobile, 2 motorhomes, my condo in Florida, and da 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 da. You start adding all these adjustments to the equation, and those adjustments present risk to the purchaser. So my advice would be, as much as possible, you really clean those books up, get them more on the straight and narrow, especially as you head towards sales, toward the time that you're going to sell. Make sure you have all the documents, records, contracts, all that stuff ready before you actually try and take the business to market. Being that if you put out the business for sale and then the potential purchaser goes and hires an accountant and says, okay, he's going to help me with this, they'll send you a list of information they want of 20 items. You want to be able to respond to those quickly. You want to know what they're going to ask for, because you want to give it quickly and in an organized manner, because that gives confidence to the purchaser that you know what's going on, that your business is running smoothly, and that you have a handle on it. If they ask for something and it takes you 3 weeks to go find it, it doesn't engender a lot of confidence that things are running smoothly and organized. And then, as documenting key process, procedures, methodologies. It's why people like to buy franchises, because they can just walk in and everything is just documented. How you open up the restaurant in the morning to how you close it, how you do cash, here's all that sort of stuff. So documenting everything is very important. Some of this I've already gone over, like don't check out early, hire your purchaser. That's just, some businesses, it's very helpful. Like if another manager is going to come in, then you hire that person, you work with them for a few years, train them, make sure they know the business. It also gets them comfortable with the business, so they have greater confidence that those future revenues are going to continue on. So again, can help maximize value. And then just realize that you're always going to be keeping a portion of the risk. So in the small to mid markets, very rarely does a business not sell without a portion of the business being sold via VTB, which is vendor take back note. So that is, if you sell your business for $1 million, you are likely going to be taking or keeping back a vendor take back for anywhere from 10% to 50%, sometimes more. The most common range is somewhere in the like 20 to 30% of the purchase price. And that's because it allows you to maximize your value while keeping the purchaser's risk lower. Being that if I'm going to sell you the business and I'm going to hold, and I'm going to withhold a portion of the purchase price, to the purchaser, it demonstrates that the seller is confident that it will keep on making money and that it will be a good investment for the purchaser. So the vendor take back allows, gives confidence to both parties. It allows splitting of risk, and it allows the seller to maximize value. They're keep invested in your business to the time of sale, keep your employees engaged. Don't underestimate the value of human capital, being that businesses with good employees that can operate things and all the rest of it are very attractive, when they're operating on their own, and even just having good employees to rely on is very important. And identify inefficiencies, get things running smoothly. Contract business increases value. That sort of just goes to the whole thing, and this isn't applicable to all business, but if you look at some of the most valuable businesses, they are, say, Rogers or a utility. And why are they the most valuable? It's because their customers are under contract. You sign a 2-year contract with Rogers. With utilities, they'll obtain even longer contract for the provision of electricity or gas or whatever it is. And so those businesses are very valuable because the customers are glued to them. They're under contract. Therefore, the risk to a purchaser that those will go away is minimized. So the more contract business, the better. Especially applicable to, say, like the HVAC business, being that service revenues in the HVAC, like so heating, ventilating, air conditioning, the revenue for service, which is for them to go out on a monthly or quarterly basis to ensure that everything is operating properly, that contracted business is worth more than the one-off installation business. And then a few final notes, and we'll get to the questions here. Just remember, business value is subjective. It's in the eye of the beholder. Two people can look at the same business, come to different conclusions for their own reasons, as far as when I'm trying to achieve fair market value or another valuator, we should be in the same range, but value is subjective at the end of the day. Make sure that you're being analytical versus emotional when selling a business. It's not personal. At the end of the day, it's not like selling the house is easy, because when you're selling a house, you have generally, if you live in a subdivision, you got 20 comparable transactions to look at. So the value that you're arriving at is fairly narrow. When looking at a business, it is subjective, and people may come to vastly different answers. And a lot of the times it's not personal, it's just that's how they perceive things. And then common issues tend to be just disorganization, and at the end of the day, both parties you got to understand you can't win everything, so common issues, a lot of time it's lawyers and accountants getting in the way, but and sometimes for very good reasons, and I'm an accountant, so at the end of the day, you got to be reasonable, and it's about getting a transaction done is about separating the risk appropriately, being that everybody's got to take a bit of risk, both the buyer and the seller. And you can't, as the seller, you can't sell the business and discharge yourself of every future obligation to do with that business, just as in buying a business, you can't do the reversal. And then as far as sales during COVID, they're still happening. So it's, I don't know, at times it's weird, I go to if you listen to the economic news, they talk about a K-shaped recovery. So that is about certain businesses are doing much better, other businesses aren't. There's a variety of scenarios, some are in the middle somewhere, but they are still happening. At the end of the day, the sort of monetary policy that we have, whereby our governments are printing a ton of money, interest rates are going down, actually has an increase on the value of businesses in general. Just this is why you've seen the stock market hit all-time highs, is because the lower interest rates push up the multiples applicable to businesses, and the governments have been injecting a ton of cash into the system. So things are still happening. So, okay. Thank you very much. Thank you everybody for joining. Sorry for running a few minutes late, and we'll go to questions now. Oh, you're still on mute there.
No,
there
we go. Okay, there are actually quite a few questions, so I'm going to ask you in the order that they were put in the chat. The first one, however, I feel that you may have answered it after the question was asked. So it is, what is meant by a balance sheet adjustment? And I believe you went over that, but if you want to just quickly.
Yeah, sure. So it's just about, at the end of the day, when you sell a business, you're selling a certain, corporation puts a box around what you're selling. And in a real estate, like I go to real estate because it's the easiest, simplest transaction to understand, because when you sell a home, you have a survey and you're getting everything within that property's boundaries. Companies are a bit more, what it actually owns and what you're getting. can be, you can move stuff off, move stuff out, move stuff in, that sort of thing. So it's just about, you were just selling the business's core assets, and essentially that you're going to take out any excess. Alternatively, some businesses are run too lean and they actually need a bit put in, but generally it's just focusing on what are the assets necessary to earn the revenues and income that it's earning. And so you do that sort of cleansing upon transaction.
Okay, perfect. So another message here, great presentation, David. If a company holds corporate-owned cash value life insurance on the life of the owner, how is that dealt with in the sale, and what are the potential tax implications?
So that's one of those balance sheet adjustments. You'd remove the life insurance policy from the company. It has to, it actually goes to more, that's where I hand it off to my tax expert. It's all dependent, because it depends what the cash surrender value of the life, like what the cash surrender value of the policy is, what its ACB is. So it can be different in each scenario. Sometimes a lot of times it can be moved out tax-free. It just requires a bit of planning and that sort of thing.
Okay. So this is an interesting one. How do you evaluate a business that the owner indicates does not show all the revenue?
So that goes to what I was mentioning about if you have a lot of personal expenses going through the business, and then you're trying to sell your business, like say the same situation, lots of personal expenses. Well, you forgot I pay for this. You make all these adjustments, they're higher risk. So in the case where they're not reporting all the revenue, it's even riskier. I find in general, people are very reluctant to pay for unrecorded sales. So if you have a business that you aren't recording all your sales, start recording them if you're going to sell them, because otherwise you can't, unrecorded sales are by their very nature unverifiable by a purchaser because they're not recorded. So you're getting, it's hard to, the only instance that I remember that, I know of that kind of people will sometimes pay for that is like smaller restaurants and that sort of thing. But then you have to have a purchaser who's willing to put in the time to verify those sales, such as sitting by the cash register for a week or two to know that that's okay. Yeah, there's the sales are there. But in essence, in my view, unrecorded sales are a very low value, and I would not be wanting to pay for them unless that can be quantified in some way, shape, or form. But they and it also presents risk to the business, because now you have unrecorded sales, which are which you're not paying tax on. So now you got issues that way, that sort of thing. So yeah, high risk, hard to pay for.
Perfect. I think that's a perfect example of sort of looking at the short-term tax advantages to setting things up a certain way for an owner, but then those can backfire on you later when you go to determine the value of the business. So here's another one. It says, if your business is in a new but fast-growing market, is that a benefit or a risk to a potential buyer, and how will that impact the valuation?
It's a risk, but a potential benefit at the end of the day, because it sort of goes to like, that's where you get into just, a discounted cash flow, where it's like a startup business. Startup businesses are inherently more risky than large mature businesses. So in general, all things being equal, it hurts the value. But if you have a business that is then going to go through an exponential sales increase, right? There can be a lot of value there. So it ends up being very subjective, and it's hard to say. But at the end of the day, I go back, it's like Dragon's Den. If you ever watch that show, one of the questions they always ask the people are, how many products, what have your gross sales to date? And sometimes the people, well, I haven't actually sold anything. Well, most of the time they tell them to walk off, or, there's going to be very little interest because it's all speculative in the future. So that's, at the end of the day, sales you don't have in that sort of exponential growth requires, it's a higher risk, and you have to find buyers and people that understand why that's going to happen or not.
Okay, great. Could you please go over the income approach valuation method and maybe discuss an example?
Yeah, so the best, like, as far as that is just sort of where, if you have a business, again, you normalize the earnings, so it might report $1,000 of earnings. You might, or say $800 of earnings. I like using round numbers here to make the math easy. But if you have $800 of earnings, you might normalize those and it ends up being $1 million. Then you apply a multiple of say 4 or 5 times, and then your business is worth 4 to 5 times that $1 million. So that's sort of the most, or at least the, without sort of being able to show examples on the screen and that sort of thing, that's the sort of nuts and bolts. And I think, you know, if I kind of go back here, that type of thing, it's just, you know, arriving at the earnings, applying a multiple, and there's your sort of total value at the end of the day.
Great, thank you. Is a website considered an asset?
Yes. Is it worth anything? Maybe. That's the thing. It's like, you know, all those, when you do sell a business, you will generally agree to sell all tangible plus intangible assets. The intangibles will be customer lists, phone numbers, websites, email, all that sort of stuff. You know, you have to think of it, human capital is an intangible asset, as in your employees, like say an electrical contractor, electricians are hard to come by. That engenders value to that business because they may have 10 electricians and all that sort of stuff. So yes, it is an asset, but it's only worth so much that it, you know, at times, say for my business as an accounting firm, if I was to sell it, yes, you could buy the website. The website's not valuable in that case. So it's all just case dependent.
So would you say an asset is only worth what a buyer is prepared to pay for it?
Yep, that's exactly.
Typically, what would be the cost of getting a small business evaluated to determine a selling price?
So that would be anywhere from $2,500 and up. You know, it depends the need and all the rest of it. There's sort of, when I get into valuations, I do notional independent reports, which have, you know, 3 different sort of depths and all that stuff. And as far as how much in detail you do, I also do some pricing analysis, which are on the lower end type of thing. Or sorry, don't have as, you know, they are, some of the reports I do are built to go to court and require a lot of diligence and detail. Certain things that I do are sort of pricing analysis where someone's just trying to ascertain an approximate ballpark for a potential sale or assisting in that sort of way. So those do cost less. And yeah, I would say somewhere starting around $2,500 to $3,000, depending on the situation, and then upwards from there.
And can you normally sort of give an estimate after meeting with the person the first time?
Yeah, generally we sort of talk, and if I take a look at the financial statements, understand what it's being used for, all the rest of it, then I can give an estimate of the cost at that time.
Okay. So this is kind of a question about a specific type of company. A moving company, for example, if property is owned, do we take the building expenses off the balance sheet adjustment if you're not planning on selling? I'm assuming that means mortgage and interest, maintenance of the building, etc. In general, is 1 year's income average over 3 to 5 years plus assets a starting point for a sale value? This is a sole proprietorship moving company. Would their capital gains form the sale? A couple of questions there.
Yeah, so we'll start with, so generally it goes to that normalization of income. So you'd look at what it's earning. You would adjust for rent to a third party. Like say you were going to sell the business, keep the land, rent it to the person, then you would adjust for those costs. Because the potential purchaser, even if they're not going to run it for the same location, needs to rent somewhere and whatever. As far as what costs remain and all that stuff, generally when you rent something, you're responsible for repairs and maintenance. And that's where the landlord will charge you a base rent of say $10 a square foot. And then they'll charge you maintenance, insurance, taxes, TMI. So that's what the sort of economic change to the income statement is. If it's a sole proprietorship, there's not really a balance sheet per se. It's a little bit more gray. And then the rest of it was, what were some of the other parts there? Like,
Okay, it says, in general, is 1 year's income average over 3 to 5 years plus assets a starting point for a sale value?
yeah, I don't know. I'd have to look it up.
Okay,
Like when it comes to like, giving, I don't like giving, oh, this is, it's hard. At the end of the day, every business is unique. And likely in a moving company, there are some sort of metrics to go by. I just don't know them off the top of my head.
okay, perfect. And I mean, if your question, if you feel that it wasn't answered, or maybe you just want to clarify a little bit, I'm assuming that I might be able to just follow up with you real quick with a couple of follow-up questions.
Yep.
Okay. So that's all that I see in the chat. So if you put a question in the chat and I didn't see it for some reason, could you please just put it in again, and I'll get a notification that there's something new. But in the meantime, I'd written down a couple of questions myself. So it was interesting what I thought you said about, the tax implications, advantages of being incorporated. And you may have already answered this, but how long do you have to be incorporated for before you can realize those tax advantages? Like, is it something where it's like, okay, I want to sell, so I'm going to go incorporate? Like, can you do that or do?
Okay. So if you were operating as a proprietorship, and so this is also like, I like to stay in the realm of my expertise. So I am not a tax expert per se. I know of the issues. If you're operating so the general rule is to meet that capital gains exemption, you need to have owned those shares for 24 months prior to the transaction date.
Okay.
There is this exception where if you were a proprietor for over 2 years, and then you did the tax-free rollover into the corporation, that then those shares qualify because you've owned the business for over 2 years. The rule is primarily met that you can't flip a business for tax-free gains. That's why there's a 24-month holding period there. So at the end of the day, there's a number of things you can do to minimize taxes. With proprietors, when we meet with them and they're selling, it's always, there's a cost to doing the rollover, incorporating a company, getting all that sort of set up. So it's often where we are sitting with the purchaser or with a seller going, okay, which is the most efficient here? Looking big picture, you got transaction costs, you got ease of sale, there's various things to sort of go on that. But yeah, I think that's sort of my meandering answer.
Okay, perfect. When a small business owner or a medium-sized business owner comes to you and they say, I want to sell my business, I want to find out what it's worth, would there be sort of 1 or 2 common things that they don't have in place that holds the process up that you could identify? Like they haven't done their homework in this area and you have to send them back and say, you need to get this information pulled together?
I mean, that's where we start. It's like, here's all the information you need to gather, right?
Okay.
The more organized you are, period, the easier that's going to be. Because some people I can give that list of information to and they can have it back to me within 10 hours. Other people, that's going to take a few weeks. It's stuff like, if you lease your space, do you know where your lease is? You might lease a photocopier. Do you have a copy of that around? Do you, just, it's all that sort of documentation that becomes important when you're selling the business. So yeah, being organized, having clean books, that sort of thing, making sure all your tax filings are always up to date, HST filings, all that sort of stuff.
Mm-hmm, mm-hmm. And is there a limit on how long a purchaser of shares can be held liable?
Purchaser of no. Well, the limits would be legally speaking.
Mm-hmm.
So that would be from a point of there's a statute of limitations,
Okay.
being that you can only be held so long. But say like just in that example with like a company that deals in environmental waste or something like that, part of them getting a license with the Ministry of the Environment and Ministry of Transportation to transport environmentally sensitive goods is that they're always held liable for an extended period of time. So, so yeah, there, yes and no. At the end of the day, you generally know, because I think just off the top of my head, like statute of limitations is 2 or 4 years or something like that. So you're generally going to know within a few years what's going on. And from the seller's standpoint, generally after 2 to 3 years, they've been paid out everything. So then, you know, they don't have any significant ongoing risk, unless it's like, you know, the only time that those don't apply is when it's really when there's more extreme scenarios, like someone was hiding something or doing something that makes that not applicable. So
let's see, one more. Are there different multipliers used for valuating a business depending on the purpose of the valuation, i.e. marriage breakup versus sale?
no.
It's easy.
The value is the value, yeah. And the other thing I guess forgot to sort of, you know, all valuation methodologies should come together, being that you should be able to value a business. I'll select a primary approach, the one I think is most appropriate, but I should be able to go and use 2 or 3 or 4 other different methodologies to come to the same value. So the value is the value. We don't do it differently for one purpose or another.
Okay, perfect. So it looks like that's all the questions, unless anything else comes up. I think I heard you mention when you did your introduction that the slide deck would be available for.
Yes, yeah, I can definitely convert that into a PDF and send that over to you. And then if anybody wants to have a copy, they can, by all means.
Okay, that would be fantastic. Thank you. So if you do want a copy, let me know. We're not going to automatically send it to everybody, but if you'd like a copy, just contact me and let me know. I have one more question here. When you say income is a factor, 1 year's income, I don't know if there's a rest of that question. That's all I see, so I'm not sure what that question means. Okay, maybe I'll add to it just as I'm wrapping up. So that was really interesting. Thank you, David, and fantastic information. It sounds like if there's one, maybe 2 messages that we're hearing, it's start early and be organized, right?
Definitely when it comes to maximizing value and make yourself redundant, document all your processes, all that stuff. Mm-hmm. You know, the easier it is for someone to step in and take over, you know, like if they have to come into the business and where'd you put this or how do you do that or that sort of thing. And if you can point them to a operating manual and say, you know, just even things like, how do I operate the Visa machine? You know, if you've got that documented, then they know when you're not there and you're gone and they've bought the business, they can flip to page 8 and know how to operate that machine. You know, like, yeah.
Yeah, policies and procedures are important, right?
Oh yeah, yeah. That's like like I said, franchisees and all this other stuff. That's just what they hammer out. They want consistency. You know, they want everybody doing everything the same way. They don't want to ask one employee, "What do you do for this?" and they tell you X. You go ask another employee and they do it a completely different way. That's bad.
Yeah, exactly. All right. So we're going to wrap up. We're 5 minutes early, which is pretty good, I think. And I've got some really positive comments here, David, in the chat. Very valuable information. Thank you, etc. And people that would like to receive a copy of the deck too. Just reminding people that we have been recording. I'm going to be stopping the recording in a moment, but that recording, once it's edited, will be uploaded to the CDC's YouTube channel. So you'll be able to go back and watch it again if you feel that there's something that you missed. As I said, this is one of the first workshops that we've done in partnership with my other CFDC partners, the Center for Business, Nottawasaga Futures, and North Simcoe Community Futures for our business transition matching program, and there will be others. If you have any questions about transitioning a business as a buyer or seller, please don't hesitate to be in touch with any of us, whoever happens to be in your geographic area. And visit our website. Keep your eyes open for some other professional development opportunities. Once again, thank you to our sponsors, the City of Orillia, Ontario Petroleum Foundation, and the County of Simcoe. And I wish you all a wonderful afternoon.
Okay, thank you very much for having me. Really enjoyed it. Take care.